This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and begin by looking at the most examined standard within the financial reporting syllabus. I guarantee that you will get examined at some point, whether it's in section A, section B, section C, within the financial reporting exam, you will see a question on property, plant and equipment. I guarantee you. So you have to know this standard, and you do already know this standard because it's brought forward assumed knowledge from financial accounting. The only difficulty that you have is that the scenarios are just that slightly more technically complex, okay, than what you've previously seen. But the key bit is that if you have that basic knowledge of the standard, you can apply that in any situation, doesn't matter how complex it is, and you'll be able to work your way through it to initially pick up the easier marks, and then as you further your understanding, you will then be able to pick up the slightly more challenging complex marks. Okay, so should we go through, do a little bit of revision and add some little bits and pieces to it to give it an exam focus? So we're thinking about property, plant and equipment. Effectively, property, plant and equipment is quite literal. It's property, so land and buildings, isn't it, that you probably use for administrative purposes, such as your head office, or maybe you are renting out some property that you might have. You could also go through as well, potentially, and own some property, such as a warehouse or a factory that you're using to produce your goods, and you're going to use it for longer than a year. And plant and equipment is effectively the machinery that you have, isn't it, that produces your goods. Okay, but again, the key bit is that you need to be using them for more than 1 year. Okay, hence why they're there within that non-current assets section. So it's important to know what property, plant and equipment is. So property, plant and equipment. Okay, but the key bit is that you're using it to produce goods or to provide services, or go through there and use it for administrative purposes for longer than 1 year. Okay, and then once you've identified that it's PPE, so at this level it's clear that it will be PPE. Okay, when you get into later exams, so SBR, your strategic business reporting, that is whereby you will see that it's a little bit more of a challenge in terms of identifying the PPE. But in financial reporting, it says that it's PPE. It's easy to spot. Okay, so once we know that we have PPE, what's the standard process? Well, the way in which we look at all of these accounting standards is effectively we look at what happens initially in terms of your initial recognition and measurement. We then go through there and look at subsequent measurement, and then we can begin to go through there and look at the derecognition. And that takes you through the story, the journey of this item here, your assets life, from when we initially purchase it to when we ultimately go through there and sell it, and then what we do in between. Okay, and we know this story already. In terms of initial recognition, we go through there and we capitalize it at cost. Once it's been capitalized at cost, we then go through and subsequently we depreciate it. We also have the option to be able to revalue, and then when it comes to the end of the asset's life, we will go through there and we will derecognize it, won't we? Okay, and we'll therefore get a profit or loss on disposal. Okay, that's it in a nutshell. Let's go through here, have a look at what we've got and cover it in just a little bit more detail. Okay, so we know that we go through there and recognize at its purchase price. So that will be the net of any discounts, net as well of any recoverable sales tax. Obviously, any irrecoverable sales tax will get capitalized as part of the cost of the asset. And then you've got any costs, is it, of bringing the asset to its location and condition. And to be specific there, that's ready for use as intended. Okay, so if there are any errors that are made in terms of the initial estimates of what we thought it would cost, those additional costs due to the errors will get expensed. Okay, but in order to get that asset to its location and condition, Any delivery costs will be incorporated. Being able to go through there and get maybe the factory floor in a sufficient capacity, so level, smooth, whatever it needs to be in order to install that machine. That is a directly attributable cost of getting that asset into its working condition. So again, that would be capitalized. Okay, you can go through and have a look at all the specific details within your tuition providers study text to go through and look at the nitty gritty. I'm not too fussed about that. I just want to ensure that you know the basic knowledge. So it's your purchase price plus your directly attributable costs of getting the asset into its location and condition. Just note, I'd say that now this is not new to IS 16. It's always been in IS 16 for as long as I can remember. But it's new, if you like, from an FR perspective. I'll touch upon it here, but we'll see it more in a later chapter when we begin to look at provisions. Because you might go through there and operate a mine. You might be doing some drilling as part of gas and oil exploration. The key bit that you've got there is that you might have to make good the damage that you have made to the land, okay, or to the seabed. Now, if you've got an obligation to repair the land or to repair the seabed back to its original condition, then you may have a legal obligation or even a constructive obligation to do so. So we will recognize a provision for that cost. But because that cost is incurred due to the use of the assets, we will go through there and instead of expensing it, we will capitalize it. So any costs to dismantle the asset, any costs to restore the land or the seabed to its original condition will be recognized as part of the cost of that property, plant and equipment. Key bit is that is going to be at present value. Okay, so therefore we would need to do a little bit of discounting and then unwind the discount. But whoa, hang on a minute. That's way too advanced at this point in time. Well, as I said, we'll see that in one of the later chapters. Okay, so that's what we do initially. Then we have the option, don't we? We have the option to either adopt the cost model or the revaluation model. Okay, so do you wish to go through there and carry it at cost? So cost less accumulated depreciation and any subsequent impairment losses, or do you want to go through there and have it at your revalued amount? And that revalued amount is there as your fair value. Okay. Again, there is a separate standard that we'll touch upon later, which helps us a little bit more with fair value. But for now, let's just take it as its market value, what we would expect to go through there and sell that asset for in its current condition. Okay. So you have a choice. Yeah, when you initially buy that asset, you then have to apply the cost or evaluation model to that particular class of assets. You need to have a consistent policy for each class of assets. So it tends to be in the real world and in the exam world that land and buildings are carried under the revaluation model, and then everything else is under the cost model. Okay. Keeps it nice and simple because, you know, if we think about it from a reality perspective, land and buildings are likely to go through there and depreciate in value. So therefore we should record that increase in their value. All the other assets become worth less, whether that's machinery, whether that's motor vehicles, whether that is office equipment. They don't appreciate in value, do they? So we'll keep those there at cost, less your accumulated depreciation. Key bit again is that we review periodically and keep the evaluations up to date. You know, what do we mean by periodically? There are no set dates when we must do the revaluation. So what we do there is we go back to the framework and start thinking about the materiality concept. So you will perform the revaluation if the fair value is materially different to its current value. If it's not materially different, then we won't bother doing the revaluation. But if there is a significant material difference, then we will revalue to its up-to-date fair value. And I think one of the key bits that you've got there is that when you then revalue it to fair value, you depreciate the revalued asset. So remember, the revalued asset is at fair value, isn't it? So you depreciate that new fair value over the remaining useful life. So if initially you had an asset with a 50-year life, and then after 10 years, you decided to revalue it, you would take that revalued amount and depreciate it over what is left of the life of the asset. So if we had 50 years, we've used it for 10, there are now 40 years left, and therefore we will depreciate it over those 40 years. Okay. Happy with that? All sound familiar? It should do, because revaluations was part of the financial accounting syllabus. Okay. There it would have been one of the more technically challenging aspects. Here it's assumed knowledge, so it shouldn't be as technically challenging as what it was previously, but it can be, and sometimes is. So just note, there will be easier parts in any question. So having done that, then the best thing to do is to go through and have a play around with the question. So what I would recommend that you do is actually work example number 1 yourself, because it is something that you have seen from financial accounting. So if it's revision, I'll try and get you and prompt you to do it yourself. If not, we'll work it together. So have a go at example number 1. If you get it all right, great. Skip to the next video, okay, where we'll be look at example 2. But what we'll do now is we'll work through example 1 in the following video, and then you can check back to see whether or not you've got it right. So work through example 1 and then have a look at the next video. I'll see you all in a moment.